Good day everyone, my name is Tamer and I'm the author of Value Machine blog. I'm an MBA student in finance and capital markets, and everything that I learned until now about the stock market was self-taught. I have learned many methods of investing by reading books and watching videos. We have a great community on YouTube, and my favorite channels are Sven Carlin and Michael J. So in this video I'm going to talk about the GDP and how investor psychology helped the stock market go higher and higher in 2017. So if you want to measure an economic activity, you should first look at the GDP. This is the figure that concludes everything. By definition, the GDP is the monetary value of all the finished goods and services produced within a country's borders in a specific time period. The GDP equation is built from consumer spending, investments, government spending, and net exports. And today I'm going to talk about consumer spending and investments. And when I start giving examples about them, you will start understanding the logic behind the market surge in 2017. So the consumption or the consumer spending is the biggest component in the US GDP. It accounted for almost 70% of the total US GDP in 2017. And that's why disposable income is so important for the health of the economy. Investments or business spending. The investments figure accounts for approximately 20% of the total US GDP. It's all about investing, which means purchasing in order to create new products, consumer goods. For instance, when the consumer have more money to spend, the demand ticks higher and the companies start stacking up their inventory and creating more consumer goods to meet up with this demand. The S&P 500 finished more than 20% up in 2017. The same thing happened with the Dow Jones, and the Nasdaq Composite almost hit the 30% gain for that year, which is really unusual for the market averages to go this much high. When we talk about the stock market, people think we're talking about tickers, we're talking about some symbols that are going up and down. But those are actual businesses. Behind those symbols and tickers, there are businesses that operates globally, operates in the US or anywhere in the world. And those businesses will benefit when the economy does better. In 2017, the US government passed the tax cuts. And reduction in taxes mean that there is more disposable income. And if there's more disposable income, it means that there is higher economic activity. And when there is a higher economic activity, it means that companies and businesses are making more money. And if they're making more money, there's more profits. Because of that anticipation, stocks in 2017 rose higher. So if we take a look at the personal consumption, it's actually a function of rates and a function of disposable income, with each one of them having a different correlation. One is a positive correlation and the other is a negative one. If we're talking about the disposable income, it has a positive correlation, which means that when it goes higher, the consumption also goes higher. And when we're talking about interest rates, it means that when it goes higher, the consumption goes lower because people will start saving more and spending less. So the corporate taxes were lowered from 35% to 21%, and companies who held cash overseas could return it to the US by paying only 15.5% taxes, and they can also return profits by overseas subsidiaries by paying 8% in taxes. Back then, before this tax cuts was passed, companies had to pay 35% in taxes plus the taxes paid overseas, and the taxes would be collected only when the money came into the US. So that's why the companies build a cash hoard overseas, and it accounted for $3.1 trillion, which is more than 10% of the total US GDP in 2018. And if we take a look at the investments parameter, companies added jobs and companies built factories, but some of the money was spent on buybacks and on dividends. On dividends, it's maybe fine, okay, but on buybacks, it's a bit problematic because sometimes buybacks hurt the investor, do not help him. It depends on the price of the stock. If you take a look at this chart, we can see the higher tick in 2018 in buybacks and in dividends. And we know that we reached all-time highs in those years. So I'm going to read a paragraph from Berkshire Hathaway's annual report in 2017, and you will understand how much the tax cuts helped companies. Warren Buffett writes, the gain in net worth for Berkshire Hathaway during 2017 was approximately $65 billion, with more than half of that figure, $36 billion, coming from Berkshire's operations. This benefit included approximately $29.6 billion related to a one-time non-cash reduction of our net deferred income tax liabilities that arose from reduction in the statutory U.S. corporate income tax from 35% to 21%.
$65.3 billion increase in net worth for the company in 2017. $29 billion of that comes from the tax changes from the U.S. government making those tax changes.
Right.
Why don't we dig into that? Explain
Sure.
what that means. How significant is that?
Well, there were two primary items, but they both reduced a deferred tax liability. We had about $100 billion of unrealized gain in equities. Now, when they're sold, you pay tax on that. And previously, when the tax was 35%, we would have had a $35 billion reserve for taxes against that as a liability. That would drop to about $21 billion. So $14 billion, roughly, was a reduction in the amount of tax that when we sell those securities, we will pay. It wasn't cash now, but it reduced the liability. When you reduce the liability, the net worth goes up.
I hope I made things clear with this example. So this is it for today. In the next video, I'm going to talk about the next two parameters, which is the government spending and the net exports. I'm going to talk about how the administration targeted those parameters too, and why it helped the investor psychology, and also how it hurt it. Don't forget to subscribe to my channel, and if you need daily updates, follow my Instagram account. So I hope you liked this video. Thank you very much for listening and watching. And I hope to hear from you. If there's any comment or any feedback, I would be more than happy to hear what you have to say. And I wish you a great day.